What's up, everyone? How's it going? Now, you may be having this question. Why do so many people miserably fail at prop firm evaluations, and why do so many people don't get paid out? Now, let's simply look at this, right? Hop onto ChatGPT, and this is what I did, right? I hopped onto ChatGPT and I simply asked this question, right? What are the pass rates for some of the world's biggest prop firms, such as FTMO? And what we see is that it's around 8% of people pass, but only around 1 to 2% of participants actually get paid. And we essentially came to the conclusion based on this data that essentially only 1 to 2% of people are successful. And in my opinion, the success rate may actually be lower than that because some people get paid even if they don't have an edge. And I'll prove it to you right here as well. And this also ties into a Brazilian research paper where over a long sample size of trades of day traders, we saw that as more and more samples and more trades got taken, people actually got less profitable because they did not have an edge at all, right? So, I mean, this is the result, right? 97% of people lost money, only 3% of people were profitable, and not many of them at all were quite profitable. Most of them were very barely profitable. And the best trader in this made $310 a day. So again, it's nothing crazy, but they tracked 20,000 traders with actual trades, and it include a big sample size. So this research paper is absolutely critical, and I mean, I don't know, it's who most people want to believe. Do they want to believe the social media content creators, or do they want to believe actual research that has been conducted by actual scholars and professionals? Now, let's don't worry about the jargon here, but let's do a Monte Carlo analysis to simply show you this phenomenon, right? Let's come back here, right? Let's use TJR as an example. He's one of the biggest mentorship sellers in the retail trading scene. And I'm not to say that his strategy does not work because I could simply not tell you that, right? Because there's a lot of discretion involved. But assuming that he has an edge of zero, so he neither makes money nor loses money, we see that in a short sample, we have quite a lot of people making money. Again, quite a lot of people losing money as well, but we look at the positive side of things, especially when selling a course, right? These people are the ones that are getting the payouts following his course, and if they get a payout, they are inclined to provide a testimony, which attracts more clients, which allows him to leverage that and make more money himself, and the cycle just keeps continuing. And that's the crazy thing about all these course sellers, right? And now let's simply assume that his edge is very slightly negative, right? Take a look at this now. This chart is a very good example of what actually happens, right? And let's zoom in as well. So what we notice is that overall, the median pathway of a slightly negative edge is that most people lose quite a lot of money, right? These are all the people losing money. I would say around 90%, right? And that's over 4,000 trades. But still, there's still a select few people that are making decent money here, right? And their strategy is quite their strategy is not profitable. But still, they're making money. Again, those people provide the testimonials. They provide the testimonials which the creator uses to leverage to gain more clients, and he gets paid from doing that, and he gets more and more money, which he can use to buy sports cars, live a lavish lifestyle, and uses that to showcase that he's a great trader. And the cycle keeps continuing, like I mentioned before as well. And I simply proved it to you why part of the reason why people think they can believe prop firms so much when they really can't, right? So that simply should answer the question in itself. Most people don't have an edge in the financial markets, and a lot of people don't even know if they have an edge. Why? They're a discretionary trader, right? And the only way you're actually going to know if you have an edge as a discretionary trader is if you track a very, very large sample size of trades. And I'm talking about over 200 trades. If you can do that, and if you provide no bias when tracking your trades, and if you can prove to yourself using actual data and statistics that you have an edge, that's very good. You should keep going and you should make a lot of money with it. But if you're a systematic trader, you can track all of these things and make sure that you have an edge before ever deploying it, and kind of not set yourself up, but you're actually kind of setting yourself up to make money. And you'll know what is a reasonable amount that you may make or lose through all this statistical testing, which discretionary trading simply lacks at. And that's what I'm doing in this overall compilation thing. Showcasing retail traders, whether that be beginner or discretionary traders that aren't finding success. I'm trying to show to them that you can start systematic trading for very little cost, and you can find a lot of free resources to get started without much experience as well. And this compilation should show you how to do that, from getting free data to the coding process and everything of that nature as well. But coming back to why people fail at prop firms, a lot of people are oversized, they don't have an edge at all, and their risk distribution sucks. People want to pass as fast as possible. We want to make as much money as possible, and we want to get a lot of prop firm funding. Why? Again, so we can make a lot of money. Now, there's an issue with this, right? So assume you're a trader with a zero edge, right? You have an edge of zero. First of all, fees and commissions are going to eat you alive, because fees only subtract from your edge. They never add to it. So if you don't have an edge, you technically have a negative edge. If you have a very small edge, you technically have no edge, right? And slippage, commissions, they all play a role into this. That is a role. And if let's say we're trading an FTMO account where we have to make 10% before we lose 10%, before losing 3% in a day, I believe, right? Now, if you have a 0% edge, we might just be hovering around this area. Now, if we over risk, right, we can come back to the Monte Carlo simulation, and it's gonna be aligned with this one. Then, as you can see, some of those evaluations will actually pass, some of them will fail. But think about it again. If we have a zero edge, does it make sense to actually pass a few of our prop firm evaluations? Not really. So, I mean, this is with a systematic approach, of course, right? Could be a lot different with the discretionary approach. But assuming you actually have a coin flip strategy where you make money 50% of the time, lose money 50% of the time, and you make zero money overall as a median path, technically you should pass just as much as you fail. Maybe failing is a bit more with commissions and fees and all things considered like that. Maybe it's gonna be, say you have a coin flip strategy, right? And let's type this down. Coin flip strategy. Let's say you pass 35% of the times, fail 65% of times, right? If this is the case, shouldn't you make money at least a little bit? Because you're kind of blocked off at your risk because of the evaluation cost, but you're not limited as to how much you can get paid out, right? So let's say you get a payout 5% of the time, and let's say your average payout is $2,000, which is reasonable, and average eval cost is I'll say typically $100 for futures. You'll see that in this situation, you're not making money nor losing money. But still, that is better than 99% of people losing money. So this is kind of crazy to me, right? If a coin flip strategy can get net zero returns, why the heck do 99% of people lose money when they trade prop firms? And again, that simply goes back to the fact that they don't have an edge at all. And what they're doing is essentially oversized gambling. And that's the crazy thing about the retail trading scene. Now, you may be wondering now, because we've talked about why so many people fail. And what's the crazy thing about all these, what's the crazy thing about so many people failing? Let's talk about how you can actually pass prop firm accounts. And in my opinion, the best way to go about this is systematically trade, if you can. If you can't, track big sample size of trades. The first step is to prove your edge. If you prove to yourself that you have an edge, with that edge and with the different statistics that you track and metrics for your strategy that you track, technically you should be able to estimate how much of the time you pass, how much of the time you fail, how much of the times you get paid out, and your average payout, right? This is the main thing, prove your edge. And we'll be showcasing in the other videos how exactly you can prove your edge, but this is just the overall view of things, right? First, you want to prove your edge. Then, you want to essentially, this is actually mainly the big thing, prove your edge. And second thing is deploy your edge. If you proved your edge, if you deploy it, and it applies more to systematically traded strategies because there's no psychology involved. Assuming you have a mechanical discretionary trading strategy, you should ensure that your discretion is actually helping you instead of hurting you. If you deploy your edge, actually, let me take a step back. Using tracked metrics, simulate a prop firm evaluation via Monte Carlo analysis. And now this may seem quite confusing. A lot of this we'll be talking about what Monte Carlo is in another video. But essentially, you can take advantage of ChatGPT, Claude Code, and so many different AI resources if you don't know how to code, and ask it to simulate a prop firm simulator for whichever prop firm you want. Make sure you're giving it the rules of the prop firm, of course, and you can simulate how your metrics may look for a strategy with different risk parameters and so much more, and you can figure out what gives you the best net positive return. So essentially, you're figuring out what makes the most money sustainable, right? And if you can do that, then all you have to do then is deploy it and track it and continue researching for more edges. This is the overall simple approach to things. There is typically a bigger framework towards this, and there's a lot more that goes into this, but this is essentially the simple framework that you can follow if you're trying to do. But essentially the point of this video was mainly to showcase why so many people fail at prop firms and what's the issue with this retail trading scene that is crazy, because even a coin flip could make money trading prop firms. So now that I've hopefully helped you understand more about how professionals think about trading, in the next few videos we'll be getting into how you can actually trade different strategies and deploy them and make money on them. And again, I think a good idea will be using a coin flip strategy, and we'll also be using a very small positive coin flip strategy and a very small negative coin flip strategy. Those three strategies we'll follow the framework, and I'm gonna work you through every step of the process in a simple aspect, because of course there's a lot more that goes into different things, but after this compilation you should be decently set up as to how you can get a start on systematic trading. Again, not recommending anyone to do anything, but if you want to systematically trade, this can help, but you always have to do your own research. But that's all I have for today. Next time I see you guys, we'll likely either talk about Monte Carlo analysis, we'll talk about prop firm evaluation simulating, and potentially something else as well, maybe something more theoretical as we talked about today. So I guess I'll see you guys then. Goodbye.